today when bad news is good news is bad news. Hello again, it's Martin North from Digital Finance Analytics, well-noticed posts covering finance and problem news with a distinctively Australian flavour. Well, the S&P 500 staged its biggest intraday reversal since March 2020 on Thursday, as US core inflation continued to accelerate. Indeed, all the hotter-than-expected inflation prints this year so far have caused the US markets to sell off, except this one. In fact, US markets reversed a 2.4% fall in early trade to close 2.6% higher, which is the largest intraday swing since the 26th of March 2020, 3 days before the pandemic bottom. The Dow closed at 30,038, up 2.83%. The S&P 500 closed at 3,666, up 2.6%. And the NASDAQ rose 2.23% to 10,649. And by the way, the Volatility Index landed at 3194. Talk about volatile, but of course volatility is a trader's friend. And Bloomberg rightly highlighted that technical levels factored into the bounce. At one point, the benchmark S&P 500 had given back 50% of its post-pandemic rally, triggering programmed buying, and a wave of put options bought to protect against such a rout moved into the money, and as profits were booked, that prompted dealers to buy stock to remain market neutral. There may be some short covering going on, but also a lot was priced in, said Michael Kontopoulos, Director of Fixed Income at Richard Bernstein Advisors. There has likely been a fair amount of defensive positioning lately in equities, and on the rates side, higher policy rates means higher probability of a hard landing. Risk assets have been under pressure all year, in fact, as central banks around the world attempted to tame runaway inflation. And the latest data added to evidence the harsh monetary medicine has yet to take hold. And it comes on the heels of last week's payroll figures that showed unemployment rates were sitting at a 5-decade low in September in the US. The Treasury yield curve flattened, with the yield on policy-sensitive 2-year notes up 0.56% to 4.4741, while the 10-year moved up a little to 3.956, still in recession inversion. Market bets on rates now lean towards back-to-back 75 basis point hikes in the next 2 Fed meetings and expect the central bank to push rates past 4.85% before the tightening cycle ends. The current rate is 3.25%. If ever there is a time for people who do economic forecasting to be humble, this is it. It's very, very difficult. The falling off of inflation for core goods has taken so much longer than we expected, Seth Carpenter, Morgan Stanley Global Chief Economist, said. So US consumer prices rose by more than forecast to a 40-year high in September. The core consumer price index, which excludes food and energy, increased 6.6% from a year ago. That's the highest level since 1982, according to the Labour Department data. From a month earlier, the core CPI climbed 0.6% for a second month, and the overall CPI measured 0.4% last month, which was up 8.2% from a year earlier. But the advance was broad-based. Shelter, food, and medical care indices were the largest of many contributors, the report said. Prices for gasoline and used cars did decline, though. Shelter costs, which are the biggest services component and makes up about a third of the overall CPI index, rose 0.7% for a second month, and both rent of shelter and owner's equivalent rent were up 6.7% on an annual basis, the most on record. Economists see the housing component of the report as being elevated for quite some time yet, given the lag between real-time changes in rents and home prices and when those are reflected in Labour Department data. Even when removing rent of shelter, services inflation still rose at a record annual pace, underscoring the breadth and depth of producer prices. Food costs rose 0.8% for the second month and were 11.2% higher from a year ago. The food at employee sites and schools index rose a record 44.9% from the prior month, reflecting the expiration of some free school lunch programs. Used car prices dropped for a third month, while new car prices continue to rise at a hefty clip. Airfares climbed, while gasoline prices subsided in September. They've since started to climb again. And Americans also experienced higher prices for utilities like natural gas and electricity in the month. Now, while the Fed bases its 2% target on a separate inflation measure from the Commerce Department, the Personal Consumption Expenditure Price Index, the CPI is closely watched by policymakers, traders and the public. And given the volatility of food and energy prices, the core index is considered a more reliable barometer of underlying inflation. And by the way, a separate report on Thursday emphasised how inflation is depressing workers' purchasing power. Real average hourly earnings dropped in September and were down 3% from a year earlier, elongating a string of declines dating right the way back to April 2021. And on the heels of a solid job report last week, the inflation data likely cemented an additional 75 basis point interest rate hike at the Fed's November policy meeting and spurred speculation for a fifth straight increase of that size in December. Traders also priced in a higher peak of the Fed fund rate next year. It's a horrible CPI number, said Andrew Brenner, the head of international fixed income at NatAlliance Securities. He wondered what the Fed might have to do on interest rates. Well, will they go 100 basis? The report stressed how high inflation has broadened across the economy, eroding Americans' paychecks and forcing many to rely on savings and credit cards to keep up. While consumer price growth is expected to moderate in the coming months, it'll be a slow trek down to the Fed's goal. And policymakers have responded with the most aggressive tightening campaign, of course, since the 1980s, but so far, the labour market and consumer demand have remained resilient. The unemployment rate returned to a 5-decade low in September, and businesses continue to raise pay to attract and retain the employees needed to meet household demand. Now, of course, the CPI report is the last one before next month's US midterm elections and poses fresh challenges to President Joe Biden and the Democrats as they seek to retain very thin congressional majorities. Already, the surge in inflation has posed a serious threat to those prospects. Seema Shah, chief global strategist at Principal Asset Management, said there can't be anyone left in the market who believes the Fed can raise rates by anything less than 75 basis points at the November meeting. In fact, if this kind of upside surprise is repeated next month, we could be facing a fifth consecutive 0.75% hike in December, with policy rates blowing through the Fed's peak rate forecast before this year is over. The composition of the inflation reading is perhaps even more worrisome than the overall number. Increases in shelter and medical care indices, the stickiest segments of the CPI basket, confirm that price pressures are extremely stubborn and will not go down without a Fed fight. And in passing, it's worth noting that gold futures was down 0.52% to 1,669, while Bitcoin landed at 19,412. So, of course, the question is what to make of this move in the market. I'm not going to make much of it. I think it's just a temporary blip. I think that when it all comes home to roost, people will see that prices are still overvalued, and we'll be watching now for the first of the banks who are reporting in the US tomorrow. And if they have strong results, there might be some short-term upside. But otherwise, expect markets to continue to grind further down. And on many calculations, the markets are still at least 20% overvalued from fair value. So we'll see how that plays out. Certainly, the Fed pivot is off the agenda. The next rate rises are coming, and 75 basis points in the US is definitely on the cards. And by the way, this will put more pressure on exchange rates, with the US dollar maintaining its strength. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.